Hello and welcome back to The Note. We continue to have drama on the bond market and relative calm on the stock market. Does this make sense, and can it really make sense to re-enter Europe given all the angst over the European bond market at present? I have a guest today who suggests that perhaps it does. He's the Chief Global Equity Strategist for HSBC, Ben Laidler. Ben, thank you very much for joining me. Let's start. What is the effect in terms of sectors in the market? What is the effect of the rising bond yields we're seeing at the moment going to be on sector allocation within the stock market?
We've just come through 5 or 6 years of remorselessly declining global bond yields in developed markets from 5% down to under 2%. Over that period of time, we've seen dramatic outperformance of what we call long duration sectors, sectors with very low sensitivity to bond yields. We've seen huge outperformance of consumer sectors, defensives, which you can see well. We think that changes here. We think we've seen the low for global bond yields. And therefore people should be rotating into what we call shorter duration sectors, sectors which have dramatically underperformed by something like 80 percentage points over the last 5 or 6 years. So we're talking commodities, financials, capital goods, a combination of bond yields which have bottomed and are potentially moving up here, combined with our view of a gradual turn in the global business cycle later in the year, we think favours these so-called shorter duration sectors.
So you're confident that not only does that mean that you might outperform the index, but that's also going to keep the stock market itself rolling on ahead if you have that turn in the business cycle?
I think so. I think that is support coming later in the year. We see earnings revisions beginning to turn up, and we can still make a fairly firm valuation case for equities, and we see it as an asset class which is still relatively under-owned.
Now let's take a look at Europe. Obviously, America was wildly overbought compared to Europe entering this year, for good reasons we've covered many times. However, there is great uncertainty afflicting Europe at the moment, both, as we can see in the bond market, driven by uncertainty over the ECB, and, as ever, there's Greece. You're still, as I understand it, making quite a confident call to be entering Europe and cutting down exposure to the States. Why?
We think you're just at a very different point in the cycle in Europe compared to the United States. We think capex levels are very depressed, earnings levels are very depressed, consumer confidence is beginning to turn up, levels of consumption are somewhat repressed. Put all that together with the weaker euro, which we think is very important for corporate earnings, given that about 50% of corporate earnings in Europe come from outside the euro. Put all that together, and we're looking for about 25% earnings growth coming out of Europe this year.
Year on year, this year, 25%.
2015, 25% year over year. Consensus is closer to 10%. So that would be a big earnings surprise, and we think would really shine a light on this underlying big valuation discount, which we estimate is about 30% relative to the United States.
And how important is margin to this? European margins are depressed. Is that true?
In our view, yes. We have European margins at cyclical lows, US margins at 30-year highs. Very difficult for us to see US margins continuing to move up here in a world where wage growth comes back somewhat. Whereas in Europe, we have wage growth which remains relatively subdued, and yet industrial production which is moving up here. And that gives room, we think, for European margins to bounce back somewhat. Combine that with the weaker euro and consumer coming back, and those are really the ingredients for this 25% earnings rebound that we see for the year.
Okay, Ben, thank you very much indeed. It's counter to intuition, but even with all the very great concerns going on in the European bond market, yes, there is still quite a case to be exiting the States and moving towards Europe.